Imagine just checking your portfolio one day and realizing that a silent, completely invisible partner has basically siphoned off $1 million of your wealth over the last 20 years.
Right. And the craziest part about that...
Do you legally agree to let them do it?
Exactly. It's the ultimate compounding variable, because the friction of those fees, it doesn't just subtract wealth that's already there. It actually prevents future wealth from ever existing in the first place.
Yeah.
And yet, I mean, it's something people just constantly gloss over until the structural damage is already done.
Well, welcome to the deep dive, everyone. For you listening, if you're, crossing that $1 million portfolio threshold right now, or maybe you're already well past it, we are taking a really comprehensive look today into the true costs of wealth management in 2026.
Yeah, we're basically decoding that visible sticker price, right? Versus the massive, and I mean massive, shit-in costs of financial advice.
We're pulling our insights today from a really brilliant 2026 guide by Davies Wealth Management. They are a fee-based fiduciary advisor located in Stuart, Florida.
Right, on the Treasure Coast.
Exactly. And they put this material together for this 1715 Treasure Coast Financial Wellness podcast.
Yeah.
So our mission here is pretty simple, honestly. We need to stop the leak.
Stop the leak. I like that.
We have to figure out how to evaluate these fees, because once you hit that high net worth tier, this isn't just, dry arithmetic anymore. It becomes this high-stakes, multi-million-dollar strategy game.
Which is really why the scale of your wealth fundamentally alters how you should be viewing these costs, because the document we're looking at, it's titled Cost for Financial Advisor, 5 Essential Fee Models Explained.
Right.
And it's an incredibly detailed roadmap of these 7 critical costs that investors with portfolios over $1 million absolutely must understand. Most financial advice articles, they're geared toward an individual with maybe, I don't know, $100,000 to $300,000 saved.
Yeah, the retail investor level.
Exactly. And at that level, a slightly higher fee percentage is mathematically, well, it's forgiving. But when an investor is dealing with $2 million, $5 million, or $10 million, the impact of just a fraction of a percent is absolutely staggering.
So let's put a lens on that scale for a second, because a 1% annual fee on a $100,000 account, that's $1,000.
Right.
It's a manageable cost. It's, a nice dinner out or two.
Right.
But a 1% fee on a $5 million portfolio, that is $50,000 a year.
Every single year.
Every year, regardless of whether the market goes up or down.
And the calculation goes so much deeper than just, multiplying $50,000 by 20 years to get $1 million.
Right, because of compounding.
Exactly. The true danger here is the compounded opportunity cost. That $50,000 leaves your account. It is no longer invested. It's not compounding at that 6 or 8% return alongside the rest of your capital.
Oh, wow. Yeah.
So when you stretch that out over 2 decades, the difference between a 0.75% fee structure and a 1.25% fee structure on a large portfolio, it easily exceeds $1 million in lost, or rather uncreated wealth.
Okay, but let me play devil's advocate here for a second.
Sure.
Isn't a 1% fee essentially just the baseline cost of admission to the financial markets?
Yeah.
Like, if an investor's portfolio is up 10% for the year, sweating a 0.25% difference, it kind of feels like agonizing over the price of a life jacket while you're cruising on a super yacht.
That's a great analogy, actually. But here's the thing. If all the advisor is doing is handing you a life jacket, meaning they're just picking a few mutual funds for you, then you are vastly overpaying.
Interesting.
A retail investor might look exclusively at portfolio returns to justify a fee, right? But a high net worth investor, they have to look at the entire financial architecture.
Which means what exactly?
We are talking about business interests, deferred compensation, concentrated stock positions, estate planning. If an investor is paying that full 1%, the return on investment must come in the form of really complex tax savings, interdisciplinary coordination, legal accountability.
It can't just be for asset allocation.
Exactly. It cannot just be for picking stocks.
Which brings us to how these fees are actually structured on paper. The source material outlines 5 essential fee models. These represent the visible costs, the numbers that actually print out on your billing statement.
Right, the stuff you can see. And the most prevalent one is the AUM model, or assets under management.
Where the investor pays a percentage of the assets the advisor is directly managing.
Yes.
And the strategy here, if I'm reading this right, for a larger portfolio is leveraging a tiered schedule, right? Like the percentage should actively decline as the portfolio scales up.
Correct. You really want to see those breakpoints. For portfolios in the, say, 500,000 to 1 million range, the industry do 5% annually. Okay.
But as that scales up into the 5 to 10 million tier, you should see that rate compress. It should drop down to between 0.50 and 0.75%.
And above 10 million.
Above 10 million, it's frequently negotiated down even further to 0.35 to 0.60%. But honestly, the core issue isn't just the percentage itself. It's what specific planning services are actually bundled into that rate.
Right. What are you actually getting for that money? But wait, that AUM model assumes the wealth is mostly liquid, right? Like stocks and bonds.
Typically, yes.
So what about the flatter retainer fee model? Because the source notes this is a fixed dollar amount, usually 10,000 to 50,000 or more per year, regardless of the portfolio size.
Yeah, and this model is absolutely crucial for high net worth individuals whose financial lives are incredibly complex, but whose assets might be almost entirely illiquid.
Okay, give me an example of that.
Think of someone whose wealth is totally tied up in commercial real estate or maybe a privately held business. Okay. So say an investor has an $8 million estate, but $7.5 million of that is just the valuation of the private manufacturing business.
Right.
And they only have $500,000 liquid in the actual stock market. An AUM model would completely fail them, wouldn't it?
It would be a disaster because the advisor would only get paid a percentage on that $500,000. Meaning they literally couldn't afford to dedicate the hundreds of hours required to structure the business succession plan, the tax mitigation for an eventual sale, or all the complex estate trusts.
Yeah, that makes total sense. They wouldn't be compensated for the actual heavy lifting.
That is the exact friction point. A flat retainer fee aligns the advisor's compensation with the actual complexity and volume of the work being done, rather than just blindly tethering it to the balance of a brokerage account.
Which brings us to the third one, hourly fees, ranging from $250 to $500 plus per hour. My read on this, based on the Davies Guide, is that it's a bit of a trap for high net worth investors who are just trying to aggressively minimize their visible costs.
It is often a huge trap. Look, hourly billing is perfectly fine for a localized, highly specific project.
Like what?
Like getting a second opinion on a specific Social Security strategy or a one-off tax question. But high net worth planning requires structural oversight.
You need an architect, basically.
Exactly. It requires someone constantly monitoring tax legislation, market shifts, estate laws all throughout the year. When the meter is running by the hour, clients hesitate to call.
Oh, for sure. Every phone call feels like it's costing you $100.
Right. And advisors hesitate to proactively research because they have to bill for it. You completely lose that ongoing architectural accountability.
Which naturally leads us to the fourth model, fee-based. And this is the structure Davies Wealth Management actually utilizes. It combines advisory fees for investment management with explicitly disclosed commissions on specific, highly regulated products like insurance or annuities, but only when those are structurally necessary for the plan.
And the absolute operational keyword in that entire model is disclosed. Transparency has to be the absolute standard. The investor must be able to see exactly how the advisor is compensated for every single recommendation. That is quite literally the only way an investor can evaluate the advice objectively.
And that transparency contrasts really sharply with the fifth model, which is commission only. I mean, if a fee-based or retainer model is like a holistic wellness concierge who monitors your health all year, a commission-only model is basically like a doctor who only gets paid when they prescribe you a pill.
Wow, yes. That captures the inherent conflict of interest perfectly, because a commission-only structure relies entirely on transactions.
So they have to sell you something to eat.
Exactly. The advisor's livelihood depends on moving clients' money from one product to another. This inherently creates a bias toward activity over long-term strategy, which is, of course, the exact opposite of what a complex, long-horizon portfolio actually requires.
Okay, so we've covered the visible sticker price, the first 5 costs.
Yeah.
Now we need to look below the waterline.
This is where it gets scary.
Yeah. If the stated advisory fee is the visible iceberg, there's a massive chunk of ice tearing up the hull of the ship underneath. The Davies Guide highlights 2 critical hidden costs that just quietly drag down portfolio performance.
Cost number 6 encompasses institutional and platform costs. And I'd say the most insidious culprit within this category is underlying fund expense ratios.
This is where the math gets genuinely stealthy.
Very stealthy.
Because If an advisor places a portfolio into actively managed mutual funds, those funds have their own internal operating costs, right?
That's right. The portfolio manager of that mutual fund has to get paid.
And that can add an extra 0.50 to a full 1% annually. And the investor never sees this itemized on a monthly statement. It's just quietly skimmed off the top of the fund's returns before the numbers are even reported.
It functions exactly like a silent mathematical drag. Think about it. If an investor is paying a 1% AUM fee to their advisor, and the portfolio is loaded up with active funds charging another 0.75% internally,
Then the actual cost burden is 1.75%.
yes. And on a $5 million portfolio, that investor is bleeding $87,500 a year in total costs. This is precisely why a fiduciary advisor will intentionally utilize low-cost index funds and exchange-traded funds to just violently reduce that internal drag.
It's honestly less like buying overpriced drinks at a club and more like having a business partner who legally skims 1% off the top of your gross revenue before you even get to see the accounting books.
That is painfully accurate.
But let me push you on this because I know what people are thinking. If I have $10 million, surely I get access to exclusive, actively managed alternative assets, right? Like private equity, hedge funds, the stuff that actually does beat the index. Why wouldn't I happily pay a 2% internal cost for a hotshot manager who's making me a 15% return?
It's a fair question. The issue, though, is the hurdle rate over a long time horizon. For an active manager charging a premium to be statistically worth it, they don't just have to beat the benchmark index.
Right.
They have to beat the index by more than their internal fee every single year, just to break even for the investor.
So they start every year in a hole.
Exactly, a deep hole. Now, while there are certainly highly illiquid, niche alternative spaces where active management can capture unique premiums, the data is just ruthless regarding liquid equities.
Like standard stocks.
Yeah. Over a 10 or 20-year horizon, incredibly few active managers consistently clear that net of fee hurdle. Rigidly minimizing those internal costs for the core of your portfolio is almost always the winning mathematical strategy.
Minimize the friction. Keep the internal fees near zero.
Exactly.
Okay, that brings us to the seventh critical cost, which the Davies Guide calls the ultimate hidden cost, tax drag.
Tax drag is the wealth killer that almost no one discusses during a standard portfolio review.
Why is that?
Because it's complicated and it requires constant vigilance. An advisor who generates excessive capital gains through frequent trading, or who fails to harvest tax losses systematically, or who just ignores the tax consequences of asset location, they are costing the investor real, quantifiable capital.
The source guide makes a staggering point on this. It says, for a high net worth investor sitting in the top federal tax bracket, poor tax management within the portfolio can actually cost more annually than the stated advisory fee itself.
Yeah, let that sink in, which means tax efficiency has to be a daily, year-round mandate for the wealth manager. It is not just a springtime activity for your CPA.
Right, you can't just dump it on the accountant in April.
No, it's too late by then. For instance, for investors with equity portfolios over $500,000, sophisticated advisors can deploy something called direct indexing.
Okay, break that down for us.
So instead of buying a mutual fund that tracks, say, the S&P 500, the investor directly owns the individual stocks that make up the index in the correct proportions.
Okay, so you own all 500 individual stocks. Walk me through how that actually generates a tax advantage.
Well, in a mutual fund, if the overall fund goes up, you can't isolate the underlying stocks that went down. You're just stuck with the net gain. But with direct indexing, the advisor's software monitors all those individual securities constantly.
Oh, I see where this is going.
Right. So if the broader market is up, but a handful of specific tech or healthcare stocks take a dive, the advisor can sell just those specific losing stocks to capture the tax write-off.
And then what happens to the money?
They then immediately reinvest that capital into highly correlated alternative stocks to maintain the overall asset allocation. It essentially mines the internal volatility of the index to harvest tax losses, which offsets other capital gains the investor might have elsewhere.
That is wild.
It meaningfully improves after-tax returns. It's a game changer.
Okay, so if this invisible drag, the fund fees, the tax drag, the advisory fees, if all of that is pulling upwards of 1.5 or 2% out of a portfolio, what is the mathematical counterweight? Like, what exactly does a high net worth investor receive to justify these costs and actually outpace that friction?
Well, we can look at the Vanguard Advisors Alpha study for a baseline on this.
Okay, what did they find?
They estimate that a comprehensively implemented advisor relationship can add approximately 3% in net returns annually.
3%, that's huge.
It is. But crucially, that alpha, that extra return, it doesn't come from a magical ability to pick winning stocks.
Right, we already established that doesn't really work long term, so where does it come from?
It comes from behavioral coaching, for one, meaning preventing the investor from capitulating and selling everything during a 20% market correction.
Talking them off the ledge.
Exactly.
Okay.
And secondly, it comes from meticulous architectural PAX planning. A great advisor acts as a financial quarterback.
So what specific high-level plays should this quarterback be calling to generate that 3% value?
Let's break down a few structural strategies that Davies points out. First are Roth conversion ladders.
Okay.
An advisor should look for low-income windows. Perhaps the years immediately after you retire, but before your required minimum distributions or RMDs begin.
Because your income drops during those years.
Right. During those years, they systematically convert traditional tax-deferred IRA assets into Roth assets. The client pays taxes at their current lower bracket, which permanently shields that capital and its future growth from the much higher tax brackets they will face later in life.
That is brilliant, which perfectly transitions into IRMAA management. IRMAA stands for the Income-Related Monthly Adjustment Amount.
Yes.
It's essentially a self-tax, right?
Yeah.
A Medicare surcharge that hits you if your modified adjusted gross income crosses specific thresholds. Walk me through how an advisor actually manages that cliff.
It requires really precise income staging. An advisor manages IRMAA by monitoring the client's taxable income closely as the year progresses.
Okay.
If taking another distribution from a traditional IRA would push that client over the Medicare surcharge cliff, which triggers thousands of dollars in extra Medicare premiums, the advisor pivots.
They stop pulling from the IRA.
Exactly. They pull the required living expenses from a tax-free bucket instead, like a Roth IRA or maybe the cash value of a life insurance policy, keeping the client's recognized income safely below that threshold.
Wow, so it's a constant balancing act. Another powerful mechanism the guide mentioned is the QCD, or Qualified Charitable Distribution. For an investor who is 70 and a half or older, they can make direct charitable contributions straight from their IRA.
Yes, and the brilliance here is that this satisfies the government's required minimum distribution without that money ever touching the investor's taxable income.
Oh, so it just bypasses the tax return entirely.
Exactly. For someone with a massive traditional IRA, stacking QCDs avoids bumping them into a higher tax bracket just because the government forced them to withdraw money they didn't even need to spend.
Man, these strategies are incredible. But wait, there's also asset location?
Right. Not asset allocation, which is your mix of stocks and bonds,
Right.
but location, where the assets literally sit. An advisor should aggressively place tax-inefficient assets, like high-yield bonds that throw off ordinary income,
Right.
into tax-deferred accounts like an IRA.
Because you don't want to pay taxes on that income every year.
Exactly. Conversely, highly tax-efficient assets, like broad market equity index funds that primarily generate qualified dividends, those are placed in taxable brokerage accounts. Simply rearranging where the assets live can generate tens of thousands of dollars in compounding tax savings over a decade.
Literally just moving it from the left pocket to the right pocket.
That's it.
These are the mechanisms that actually justify an advisory fee. And that structural planning, it has to coordinate with the evolving estate tax landscape.
It absolutely does.
The Davies Guide highlights the sweeping impact of the 2026 One Big Beautiful Bill Act. And look, just to maintain total political neutrality for everyone listening, we are purely looking at the financial mechanics of this legislation as outlined in the source. We're not taking any sides here.
Of course.
But basically, this act makes the federal estate tax exemption permanent at $15 million per individual, or $30 million for a married couple.
Which permanently alters the estate planning playbook. I mean, for decades, a major focus of high net worth estate planning was frantically moving assets out of the estate before death.
To avoid the estate tax.
Right, to avoid that massive 40% federal estate tax hit. But because this $30 million exemption is now permanent, that deadline-driven urgency vanishes for the vast majority of investors.
Which means the strategy shifts entirely. If the federal tax is no longer the immediate threat, what is the new primary objective?
Maximizing the step-up in basis.
Okay, just to clarify the mechanism for the listener. A step-up in basis essentially resets the taxable value of an asset when it's passed on to an heir.
Right.
So if an investor bought a stock for $100,000 and it grew to $2 million over their lifetime, Their heirs inherit it with a new basis of $2 million.
Which is huge.
Yeah, because the $1.9 million of capital gains just vanishes from a tax perspective.
It's completely wiped out. So the advisor's job is now to strategically hold highly appreciated assets within the estate to capture that step up, while utilizing mechanisms like dynasty trusts to protect those assets from the heirs' potential creditors or future divorces.
So how does an investor actually verify that their advisor is capable of executing this level of complexity? I mean, the source emphasizes the fiduciary standard, the legal obligation to act in the client's best financial interest, which is how Davies Wealth Management operates. But how do we translate that legal standard into real-world red and green flags for the listener?
Well, a glaring red flag is a portfolio stuffed with high internal cost active funds, paired with total radio silence on proactive tax planning.
Basically, if they just set it and forget it.
Right. If an investor's estate plan, insurance policies, and investment portfolio have never been reviewed together in the same room by the advisor and the estate attorney, the investor is almost certainly bleeding capital.
And the green flags.
A green flag is an advisor who initiates tax planning strategies, like those Roth conversions or direct indexing, without the client even having to suggest them.
They bring the ideas to you.
Exactly. It's receiving a comprehensive written financial plan that models multiple future scenarios, and it's updated every single year. It's an advisor who views the CPA and the estate attorney as essential teammates and actively coordinates with them.
I want to pose a practical challenge based on all of this.
Let's hear it.
Because if a listener realizes right now they need to scrutinize their current advisory relationship, how can they confidently ask their advisor to quantify this value? Like, what is the actual litmus test if the advisor just points to last year's S&P 500 returns and says, hey, look how much money we made you?
That is a very common deflection.
Huh.
The investor should demand a total fee disclosure in writing, period.
Meaning everything.
Everything. That means the stated advisory fee, the underlying fund expense ratios, and the transaction costs. Once that total structural cost is visible on the table, the investor asks one specific question.
Which is,
Can you outline and estimate the annual tax savings generated by your specific structural planning over this past year?
that is brilliant.
Right.
Because if the advisor deflects back to portfolio returns, which, let's be honest, are largely dictated by the macroeconomic environment, it means they aren't generating their own value through actual planning.
Precisely. For a multi-million-dollar portfolio, the tax savings from asset location, direct indexing, and IRMAA management, those should routinely be in the tens of thousands of dollars. If the advisor cannot specifically point to those mechanisms, they just aren't utilizing them. The overarching reality here is that you cannot evaluate a high net worth wealth manager using retail investor metrics.
Wait, I think you mean...
Oh, sorry, yes. Paying a fair price for genuine interdisciplinary expertise is an investment in wealth preservation, but it only functions as an investment if the transparency is absolute.
This just changes the entire perspective. The fee isn't just a deduction, it's an active lever.
Exactly.
Well, before we wrap up this deep dive, I want to leave you, the listener, with a final forward-looking question to explore on your own. We discussed the massive 2026 federal estate tax exemption, which permanently protects up to $30 million for a married couple. But how does your specific state view your wealth?
And that is the blind spot for so many affluent families.
Tell me about it.
While the federal horizon is protected, numerous individual states enforce their own estate taxes with dramatically lower thresholds. We are talking sometimes kicking in at just $1 or $2 million.
So ask yourself right now, does your current financial advisor even know your state's specific estate tax threshold? Are they coordinating your trusts to mitigate a state-level wealth transfer tax, or are they only looking at the federal horizon?
Because if they aren't optimizing for your specific local jurisdiction, that is a massive invisible leak in your financial haul.
It is exactly those nuanced questions that separate basic investment managers from true wealth architects.
Absolutely couldn't agree more.
Thank you for joining us on this deep dive into the true cost of wealth management. Remember, the sticker price on your financial advice isn't a simple, isolated transaction. It is a living, compounding variable that actively shapes the trajectory of your legacy. Evaluating your real, total fee impact today is truly the most powerful investment you can make for your future wealth. Until next time.